G'day everyone. Before we get started in the podcast today, we would really appreciate it if you could fill in the survey down the bottom there. It won't take too long, but it would really help us in improving the quality of the podcast. Thank you.
Good afternoon, Shane. Did you actually get any sleep after the federal budget last night? Because it was so exciting. Must have been hard to sleep.
No, I always sleep well. As soon as I hit the pillow, I go to sleep. So yes, it was exciting, mainly because there was so much in it. But it had a lot of anticipation because it had the Economic Reform Roundtable. So I was hoping for lots of deregulation and productivity enhancing reforms to grow the economy and make young people feel richer like their parents. But then it got sidetracked a little bit by the war and the problems there, and also intergenerational equity has become more of an issue. So, but you should be really happy. Aren't you a Z?
I'm actually at the tail end of millennials and beginning of Z. So, I mean, I think of myself as millennials more, but I would say I do have a lot of
So do you feel happy after the budget?
I mean, well, yes, the budget was definitely geared towards millennials and Gen Z. And you know how those two generations are now starting to outstrip the number of population in the interwar or Gen X and the boomers population. So
There's more of them.
Yeah,
I think you've got to add in alpha, haven't you? You've got to add in alpha.
But only among the 18 plus though. So like Gen Alpha, a lot of them are under 18.
Oh, right, yeah.
That is why. Anyway, so a lot of issues.
But isn't there another problem that millennials are actually getting quite old?
Yeah, but not me.
They're not you, but the oldest millennial is like 46 or something, or 45. Yeah, they're not actually young people anymore. They're the sort of people who would be negatively gearing a property.
Anyway, so the context of this budget is that those groups are starting to outstrip the numbers in the voter base for the government. So they're starting to cater to these groups more. Judging by the number of TikToks and Instagrams that Jim Chalmers has been doing the past 2 months, you can definitely tell that he's really trying to cater to social media as well.
It's a bit like me, trying to appear on Instagram.
No, you do want to appear on Instagram. I don't think Jim Chalmers is as good as you. But the government, that was the government's promise to address this intergeneration inequity between the millennials and the Gen Z versus the boomers in particular. And again, the reason why they do that is because it's perceived that millennials and Gen Z haven't had the same chance to get onto the property ladder as the older generations. It is perceived by the common Australian that a lot of the failures in housing market has been due to the fact that we've had generous tax concessions. For example, the 50% capital gains tax discount since 1999. They have had negative gearing allow them to offset losses in investment properties against their own income, which propels more risky lending and risky investing in the housing market. So those are the things that the general public perceive. And I think that the government is really trying to solve this issue by touching those things that seemed untouchable a few years ago. They do want to solve the intergenerational inequity through some additional measures in productivity, some little tax cuts for workers, for example, the $250.
They go to everybody though.
Yeah, they're given to everybody, but they are geared towards workers, but they are quite marginal.
But what do you make of the argument that it's, if you look at it at a point in time, a young person today often does not have a house, whereas an older person has a house and lots of super, and so they're wealthy. So you look at it, there's a huge divide. But then again, I thought the same thing in 1985 when I was a young person, and I looked at my parents. They got so much. How can I possibly ever have that? And, you know, there was a degree of envy there. But I kind of thought, well, my time will come. And then eventually it did.
But statistics has shown that the millennials and Gen Z time is coming later than previous generations. Like they are still buying homes.
Isn't that because they, like when I went through high school, I reckon 1/3 of kids, maybe 2/3 disappeared at year 10. The rest of us went to university, and the degrees then, they weren't, I mean, my kids went to school and they were all combined degrees. Turns out mine was as well. But these days more people do combined degrees, so they're at university for longer. And then there's this idea that, you know, we're young now, we want to have fun, we want to go on the world tour. And I'm just mouthing things you hear out there. And then, and go to the cafes. I mean, in my day, there wasn't even cafes, it was just milk bars. You wanted some tea, they'll give you a tea bag. Coffee, you get some instant coffee sort of thing. And so you had much less to spend on, so it was natural to want to have kids earlier. And I think also in the post-war period, I mean, it seemed like having the family home was the bedrock of everything. You had to have a house because that's where you'd feel secure. Whereas all those things, those values have changed. People get married later, they go to university longer, they want to do more life experiences before you get into housing, and so on. So maybe that's a factor. It's not just because of poor affordability. I know I sound like a boomer, but if you look at the facts, you kind of think maybe that is going on.
I mean, I agree that there's part of it as well. I think the lifestyle has changed nowadays. Like even if you have a house, like people have kids later as well, because people don't seem to have to want to build a big family that early in their life. But statistic has also shown that house price growth per annum have gone up over the years. And it's accelerated. Agree. And it has gone up a lot more than the pace of wages growth in Australia, which I guess is the source of angst here from the general public. So I think we should go back to the basics, like, what are the governments actually changing? So
why has that happened? Is it, like, I mean, my theory, I used to think it was all negative gearing and capital gain. Then I came to the view that, well, we've had too many people come into Australia, and people coming to Australia are great. I think that's a fantastic thing, but the trouble is you can have too much of a good thing. So we had a lot of immigrants come at a time when we weren't building enough homes, and if we end up with a chronic undersupply, and I reckon it started 20 years ago.
It's true. I think that in terms of economic thinking, more immigration into Australia doesn't necessarily mean a good or bad thing, because it should add both to the supply and demand side of the economy.
Yeah, the RBA points.
The failure in Australia is that you're getting immigrants that only add to the demand side of the stories. For example, you get a lot of, people who come here to retire, for example. You don't necessarily get more talents coming here to work in productive jobs.
Few.
There are, but
a lot of migrants come here and do the jobs that Australians don't want to do in the care economy, for example.
But a lot of them don't work in construction, for example. So that's the issue. Like, you don't necessarily add to that supply capacity as much as you're adding to demand, which I think is the issue in Australia.
But if you look at it mathematically, that's the basic point, that the population-driven demand for housing has exceeded the supply of housing, and that's led to a chronic undersupply.
So we have established that we do have an issue in housing in Australia because demand has been growing too fast versus supply. But how is the government trying to solve it in this budget? So let's go back to basics.
But before we do that, a cynic could sort of say, well, for the last 4 years, the government focused on supply.
Did they?
Well, we had the housing accord.
But they didn't.
Yeah, I know. But I'm saying that was what they were saying.
Yeah.
They said we focused on supply. We didn't do these things because we were focused on supply. Now it looks like, well, that didn't work. House prices have gone up again relative to people's wages. All measures of housing affordability have gotten worse and worse, not better. So therefore, we've got to do this.
Okay, but so what is this? Let's just break it out for our listeners.
A cynic might say, well, you didn't do the thing that you actually needed to do, boost the supply and get the supply-demand imbalance under control. That's still out of control. The housing accord or graph, 240,000 homes a year. We're only building 180,000 homes a year.
175.
Yeah, so now the going's got tough. We'll go down the other approach and just change the optics a little bit and say we're doing something. Oh, we're going to change negative gearing and capital gains tax. Yeah. Whereas in reality, they may not fix the underlying problem.
Yeah, I mean, again, I agree. I just think we should go back to the basics and explain what exactly are they changing. So in terms of the capital gains, since 1999, when you buy an asset and you sell it later, whether it's house, it's shares, you're taxed on the nominal changes in the growth of prices of that asset. Basically, all the gains in house prices that you have gotten. But when you're taxed at your marginal tax rate, less a 50% discount on that marginal tax rate. Now we're not doing that anymore. We're only taxing real gains, which is that gains subtract the growth in inflation over that same period. That's called real gains.
So if the price was up 8% and the real
and the inflation was 2%, then you're only taxed on the 6%. Yes. But you don't get that discount anymore. You're taxed on that full 6%. And I think the surprise yesterday was that you are also subject to a minimum 30% tax rate on that real gains.
So that means basically if you're working on a strategy, I'm going to buy this house and I'm going to hold it till I retire and I don't pay any tax, and therefore I'm on a low marginal tax rate, therefore I can minimise my capital gains.
Now that doesn't work anymore.
Because you've still got to pay 30%.
So the difference between those two schemes, I think in the short term, if you have short holding periods, it doesn't make that much of a difference. And you actually might be better off under the new inflation indexing scheme if there is high inflation, because it inflates your cost
So lower
base.
capital growth and higher inflation,
Yes.
you might actually be better off.
Yes, but for longer term holding periods, for example, for older boomers who can hold their assets for really long and are in a lower marginal tax rate to when they're not working anymore, then they will be hurt from this change. Well, what do you think about that?
I always thought the capital gains tax discount was too generous.
Yeah.
So I don't mind the change. I mean, I'm actually on the record you can look at Oliver's insights, how do we fix up housing affordability? I don't mind moving back to the Paul Keating model, which was you tax real capital gains, providing that capital gain can be spread. Because you can do the maths on this. If you're an income earner earning, say, $100,000 a year, but if you're a capital gainer, you just get one big capital gain because you had a small business, you sell it off, of, say, $1 million, and over 10 years, who will pay the most tax? It'll be the guy with the capital gain. But over the whole period, your income's identical. You should be able to smooth that capital gain to minimise your tax bill in some way, which is what the Keating model allowed for. So I think that change was reasonable. The one that negative gearing probably has a much bigger impact.
Okay. And what were the changes in negative gearing?
Well, negative gearing, but basically negative gearing enables you to deduct a loss on a property investment or more property investments from your income to reduce your taxable income. Now you can't do that. So you can deduct the costs up to zero. So you've got an income of rent and net rent, whatever, you can deduct your mortgage costs from that, but you can't deduct a loss from your overall income. So now, interestingly, you can carry it forward. So if you have a loss in 1 year and you're heading from being negatively geared to positively geared, where you're no longer making a loss on that property, then you can offset it against income in subsequent years. So it's not all bad in there, but basically it means that the idea of a negative gearing strategy where you maintain a constant level of debt and the interest on that is above the net rent, that's no longer a viable strategy. You can't do that unless you buy a brand new property, new build, then you can do it. But for existing owners of rental properties, existing arrangements continue indefinitely. If you buy from budget day onwards, then the new arrangements kick in from July 2027. I mean, that's probably the bigger one that most people probably get impacted by. The capital gains tax one worries me a little bit more, but mainly in relation to startups and small business. The government's talking about consultations to carve out startups and tech and venture capital and so on. And so they should, because it could be a disincentive to innovate and start a new business. But it might also have an impact on the share market because it could bias share market investors. So share market, these changes in negative gearing only affect residential property.
Existing residential properties, not applying to new builds either.
Yeah, they don't apply to new builds either, but they also don't. Those changes don't apply to shares or commercial property or other investments you might make. So in that sense, the share market could benefit from this because it's it's a relatively more attractive destination because it's not subject to the changes in negative gearing. You might say the same about super. Super becomes a more attractive investment destination for investors. But where it could affect the share market is that in the mix, so it might favour income-bearing shares, so high dividend-franked shares, dividend-paying shares, and less growth shares, because the growth shares, when they earn a capital gain, might be taxed more, which could mean less capital for growth companies on the share market, which could be a potential problem and potentially contradicts the government's desire to boost productivity.
So I actually do feel mixed about this as the target recipient of these policies, because I think that, as you've said, some older millennials are now starting to get into the market because they've worked for a while. Now they're not getting the same sort of concessions that boomers have enjoyed all their life now.
Yeah,
so
they might think, well, you
it's
guys
not even
got
fair.
it. You guys got it. It's sort of like this argument, the boomers had free high school education.
Yeah.
And then it got too expensive, so the boomers knocked it out, It's the same thing. The boomers have got and Gen X got the benefit of it. Now they decided it's no longer right. Well, we'll knock it out. And so it benefits younger people in the here and now, arguably, at least from a perceptual point of view.
Yes.
But it may work against them in the longer term because when you get to 46, say, your mortgage might be under control. You might decide, well, I want a negatively geared property now. Now you can't do it.
And two other things. I think this is according to the Treasury own forecast that, some supply of homes actually might be constrained in the short term. They think that...
They're 35. Yeah, we spent last night, Deanna, it's funny.
Yeah, I was trying to find it too.
Yeah, you're trying to find, yeah.
Because it's hidden in hundreds
of pages. It's on page 158.
Oh my God, look at this.
You're going through hundreds and hundreds of pages trying to find this because I saw a reference to it from the housing industry.
Yes.
And I thought, what, they actually said that? Maybe the housing industry has made it up.
They just hide it.
But they hadn't made it up. It's actually in the budget papers.
Yes. An
estimate on page 158. It says that because of the tax changes, the supply of housing over the next 10 years might be $35,000 less.
Yeah, so there's actually a little bit less housing supply in the short and medium term. They think that they will be made up in the longer term. And in terms of rents, they also think that rent prices would actually go up in the short term by at least $2.
But how does this help younger people?
Exactly. So that's why I said I think it does help with the perceptions, but it doesn't necessarily help in the long run because again, yes, I think in the long run, there might be more shift towards first home buyers as a share buyer in the market versus investors. But it doesn't necessarily mean that this is fair across all generations, as we have said. I think another impact of that is also that, say, for shares, for example, you're essentially punished by holding investments for longer periods of time because that's when the punishments from this, real gains tax is a bit more prominent. So it actually might drive investors towards more dividend-paying stocks. And Australia already has the highest, share of dividend-paying stocks.
It just means that there's less capital in the share market for growth stocks.
Yeah.
Which may reduce the dynamism of the Australian economy.
Yeah. And business investment in Australia has been very low. And this is an incentive for companies to pay dividends rather than banking it to invest back into their companies later on. So is that actually a good thing? And in the long sustainable term, I think that's a little bit more doubtful. I think that, again, and the other thing with the whole changes to negative gearing and capital gains tax concessions are, why do people need it? It's because we have really high income tax rates in Australia. You've said this many times.
Sounding like a baby boomer.
No, but the reason why there are these things that happen because we have such high marginal income tax in Australia that reached 47%. That's actually among the highest in the developed world, in the OECD.
And it kicks in at a low multiple of average
so it's a large proportion of the population gets into that tax bracket.
Yeah, so we have a high tax bracket and relatively high marginal tax rate, and it kicks in at a low level. So it affects people a lot more than in other countries.
Yeah, so the issue with the budget is that there's not much tax cuts for the working age population. According to the budget forecast, still around 70% of cash receipts are still coming from income taxes, whether individual or business taxes. Or business income taxes. So there is still a much reliance on bracket creep and tax hikes in Australia to actually pay for the government, to pay for the aging population, to pay for all the growing needs in healthcare and social workers and NDIS and all that sort of stuff. So is that even fair?
Again, in the budget papers, there's a graph which shows government spending over time as a share of the economy and revenue will go to a record high in the decade ahead. And the reason it's going to a record high of 27% is because of bracket creep, more people going into higher tax brackets that they weren't intended for, and obviously these tax changes. They start to collect more revenue from capital gains tax change and negative gearing change, and of course the 30% tax on trust distribution. So it's you could argue that they are relying more on higher tax to get the budget back under control.
So that's not fair at all. We are paying, our generation is paying for everyone.
Well, that's the problem, because my generation will retire and we'll go into retirement. And younger generation, Z, and then increasingly alphas, and to a lesser degree millennials, or millennials as well, they're the ones facing the burden here. And that's why I kind of thought, well, okay, from a tax reform perspective, the capital gains tax discount might be a bit too generous, so it could be wound in a little bit, and negative gearing could be restricted. But if you're going to do those things, then you also have to get down income tax rates.
Yeah.
And unfortunately, we didn't see that. And so therefore, I'm not going to call it proper tax reform. It's really more like a tax hike.
Yeah.
And only fixing a small little bit of the problem, not the overall problem.
Yeah, it's tinkering around the margins.
It's tinkering around the edges. The other thing that worries me a little bit is that I got into property. So you go back to the late 80s, early 90s. The perception was that Australian property then was expensive.
Yes.
It was perhaps more because of the high mortgage rates at the time.
Yeah, 17%.
Yeah, but I'm not going to get the violin out because it just sounded like old people always do. Oh, things were so tough in my day.
Yeah.
But the way my wife and I got into the property market was as rent investors. Initially, we were at home with our parents and we bought a property and negatively geared it. So that enabled us to pay down the mortgage fairly quickly using the tax refund you get after the negative gearing. And then the same thing when we got married and moved in together and what have you, we were able to do the same thing. And we were able to get a house that we wanted, but it was rent vesting. We were using the tax. Now you can't do that. Young people can't do that sort of thing, which seems to me is a little bit unfair, but I don't know whether people realise that.
Yeah, I mean, if you read social media nowadays, and I do see these kind of examples being like shown on, people would say, newspapers that lean a little bit more right, and people are actually kind of mad about it because they keep saying, oh, we just want to get into the markets. Who has money to invest? But I think that's the wrong mentality for the younger generation in Australia. I think if you are a young person belonging to the millennials or Gen Z or even Gen Alpha generations, then we also have to remember that Australia is a relatively rich country. We're actually starting off from a high base of standard of living. Again, that's why we can actually afford to pay for things like NDIS or social care or aged care. We have a pretty low unemployment rate in Australia versus all of our peers abroad. It's only above 4%. It's actually much better than throughout most of our histories. It's quite easy to get a job, especially in certain industries nowadays. So I think, I mean, like as someone not born in Australia, I do think there's a little bit of this tall poppy syndrome when, like...
Oh, I love that. Pull people down rather than pull them up.
When you have to think that, if you want the country to get up, you have to incentivize the people at the top. You have to actually get more people who belong in the top tax brackets to come here because they do pay more tax. They are more productive. Or if you have this certain amount of income, you should try to invest it. Even if it's $10 a week, there are actually a lot of brokers nowadays that have very low investment fees, or your super, that's a great investment vehicle. Even a little bit extra every single week can actually compound into a very big amount in the long term. So those investment incentives should remain there for young people to actually build wealth. I think we work in superannuation, we understand this very well, but a lot of people don't understand that. So I do want to actually put that out there that,
So you're not actually supporting these changes?
I think that the government is moving in the right direction. Like they do want to touch productivity. They do say that
there were some good things in the budget in terms of
lower compliance
reforms,
rates,
deregulation, and so on. Yeah.
But I do think that like a lot of the tax changes are just tax hikes. So it doesn't solve the root of the issues that the younger generations.
So just on another issue, you would have liked to see more gas tax in the budget.
So I recently got a bit of hate about this because I did post a video saying that we should tax gas more, but not because they don't pay anything. Because in reality, they do pay a lot of money. In terms of income taxes, they've actually made quite a bit of money. The things that they are underpaying is actually rent taxes, basically a tax that is thought of as, the money they use to pay to the general public because it's a public goods. They need to buy that thing to actually export abroad. And I think that's the part that needs to be to be taxed a little bit more. Not necessarily, I don't think that raising tax rate to 25% of all gas exports is the solution to everything here.
Because it's nonsensical to say that we haven't benefited from the mining and the resources booms because we've every budget. I mean, this budget saw $40 billion worth of upgrades over 5 years to government revenue because of revenue from the resources sector. And I think you added up over the last 5 years, the current term of the government, it's 300 to $400 billion, depending on how you add it up. So massive amount of money coming in. And when you look at Australia in terms of its per capita GDP and its wealth, it's actually quite high.
Yeah, agree. So we have gotten rich from resources, and that's not a bad thing. That just reflects the global demand.
But your argument is more that the resource, what's it called? The petroleum
resource rent tax should be a bit higher, and there should be less loopholes in it.
So it's not optimal. It was originally for, obviously, petroleum, and then now it's applied to
gas,
gas because it's an offshore resource. But if it's an onshore resource, say gas in Queensland somewhere,
then they pay state royalties.
Yeah. So this is for offshore, and it's arguably because of all the
deductions.
Yeah. So why is there an uplift factor in there where?
Because they think of that. So, okay, going back to basic, the reason why gas companies haven't paid a lot of rent taxes are because they get a lot of big deductions in the first year of the project. And
so this is when they're investing heavily and
into plants and equipment.
This is not like Qatar. You've got to do a lot of extra work in Australia to get the gas out.
It's not like Norway. It's not like Qatar. It's a lot harder to actually invest here.
You've got to convert the gas to
LNG. Hey, I'm doing the basics. Yeah. So basically the difference is
the theory is this is all a lot more costly than in these other countries.
It's very costly.
We should give them some allowance for that.
It's very costly, it's very costly, and also you don't want to scare them away. It's quite risky
you want
in Australia.
Them to come here than go to some other place.
It's quite risky to do that in Australia as well, because a lot of times they dig things up and there's nothing underneath, for example. So you want to guarantee them a little, minimum return of investment so that they actually do come here. So that's the theory behind it. But the issue is that a lot of the companies can take these massive deductions all at once. Unlike any other company taxes, you usually have to depreciate it over a long period of time. These companies can just take it, and every single year they can grow these deductions according to some sort of inflation or GDP factor. So it's the
initial investment?
Yes.
They don't take it all at once, but it grows over time.
You can take however much you want in the first year, and then whatever's left, you can keep growing it over time. And that's the factor that's different from any other companies.
Wouldn't that be right? What's wrong with that? Because it would be worth, if you spent it in year one, but you could have alternatively invested that in a government bond, say, and therefore its amount would have been a higher amount in year two.
I think it's unfair because I think the indexation or the uplift factors have been quite high over the last few years, and no other companies have this sort of ability to offset their taxes like that. If you think about company taxes, they cannot do this. And same with royalties, they cannot do this kind of thing. So,
but they would be companies are writing capex off over years, like in
yes, over years, but without an indexation or without an uplifting factor. It's only like this rent tax that allows you for uplifting. So again, there's a lot of nitty gritty. It's very niche, but the result is that we haven't really collected a lot more rent taxes versus revenues, even if we have had high prices.
So is the taxation of gas coming out of Queensland, is it fair to Australians?
Do you think the royalties, are they fair?
Yeah, in Queensland.
I think they are more fair. In Queensland, actually, they have this scheme. This is for coal though, but they do have this progressive tax system when if the commodity prices are higher, then you collect it at a higher rate. I actually think that's fair. I mean, that allows them to actually to share in the windfall profits a little bit more.
That seems reasonable.
I don't think it's a bad idea. But anyway, this budget, they actually don't touch any of the gas taxes. I think it's okay. I mean, there are a lot of issues.
You could argue that's a sensible thing because there's a world shortage of gas on. The Strait of Hormuz is still shut. We've gotten bored talking about it, so we're not talking about it. But the issue hasn't gone away.
Yeah. Yeah, I agree. Which is why the government doesn't touch it this time. It doesn't mean that they won't ever touch it. And I also don't think that it's the cure-all to all of our issues with taxes and budgets. I still think the root issue in Australia is just that high reliance on income taxes, which, again, haven't really been solved.
Well, we better wrap up soon. So what are the three things that you would have liked to see in the budget that weren't there or you would like to see more of?
What would I like to see more of? I should ask you this question as well. But from my end, I think three things I would love to see more of is probably one, a bit more focus on reduction in qualifications and compliance in a wide range of industries. For example, healthcare, make it easier for doctors to come in, or especially the construction industries, more recognition for foreign tradies because we desperately need them. If you've ever done renovations in the past 2 years, you would know. The second thing, as I've mentioned time and time again, is a reduction in marginal income taxes, especially in the top tax rates, because I think we need to attract more talents to Australia. We're not doing that with that 47% tax rate. The third thing, what is the third thing? Hard to say. I mean, I can talk about it from
you want to tax illegal smokers more.
We were talking about this. So the government admitted that they're collecting $8 billion less from excisable tobacco duties over the next coming 5 years. And that's actually a massive amount of money. That's more than what they're earmarking for the additional fuel reserve in Australia. They're only earmarking $7.5 billion. This is $8 billion in tax loss because they raised tobacco taxes too much.
Yeah, the rate went too high, so they went down the slopey part of the Laffer curve.
Yeah, so people resort to illegal tobacco instead. So the government actually ends up collecting less money when they hike tax rates, which is what called the Laffer curve. So yeah, I think that is a good one. They should probably make that part a little bit more efficient. And it is a good example for it to show why tax hikes doesn't mean more revenues for the government.
Yeah. They go too far.
What about you? Let's do three things that you wish to see.
3 things I would have wanted would be less government spending. So they did widen government spending back a little bit, but mainly in the out years. In the near term, actually, I think there was a bit more stimulus in the economy. So I think government spending is actually acting as a bit of a problem in Australia in the sense that it's running at much higher levels than normal, about 26, 27% of GDP. It used to be below 25%. So that means when private sector spending grows, it bumps up against capacity constraints and causes inflation. So ideally, you'd want to get the level of government spending back down. So that's number one. And my rough estimate was you need to cut about $100 billion out of government spending over the next 3 years. Number two is, I agree with you on tax. I think we should set a decent tax reform package. If you're going to do these things on negative gearing, capital gains tax, trusts, my pet love would be to raise the GST as well, because it's a non-distortionary tax. Then you would lower income tax rates across the board. And that, I think, would be a good thing at the lower end, but also at the higher end. And the reason you would do that is that it takes pressure off younger generations. If you want to fix up intergenerational wealth, that's one of the ways to do it. Reduce their income tax burden, and you'd collect a little bit more out of people like me when I move into self-funded retirement via the GST. And the third thing, I think you just need to see more deregulation. There was good moves in the budget there. I've got to give them some credit for that. But I'm not sure that it's enough. And in the last few years, we've seen more and more labour market regulation, which makes it harder and harder to do things. So that's what I would have liked to see. Less government spending to get it back to where it used to be. I'm not saying take it all the way below that, back to where it used to be. Proper tax reform, broad-based tax reform, less reliance on income tax, and more deregulation. Then I would have given it 10 out of 10. But unfortunately, we didn't get that. And the sad thing is this is the budget when it should have been done because the next election is 2 years away and the government got a huge majority in the parliament. So they've got a lot of political capital.
If not now, then when, right?
If not now, then when? Precisely. So anyway, it's been fun. I hope that was of some value. Next time we'll be back to talking about the Strait of Hormuz, if we're not bored with that. But anyway, until then, thanks, me.
Thanks, Shane. And if you guys have any questions, please feel free to drop them down below and we'll answer them.
We will.